Good evening, everyone. Welcome to the channel. Today I am going to talk about Ooil interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. Orient Overseas International Limited offers a diverse range of businesses and services across various industries. These include container transport and logistics services, supply chain management, shipping and liner agency services in multiple trade lanes, integrated services, software application development for shipping and logistics equipment owning and leasing, container depot and warehousing portfolio investment, trucking, ship owning and chartering terminal operating, cargo consolidation and forwarding transportation and freight agency, property owning ship management and vessels operation AI, and blockchain digital data on network applications, platform design services. These businesses and services are provided across multiple regions including Asia, Europe, North and South America, Australia, and Africa. The oil stock price conundrum, a year of decline. Contrary to expectations, the crude oil prices have experienced a decline over the past year. As of September 18, 2025, crude oil was 10.32% lower than it was a year ago. This downward trend can be attributed to several factors, including decreasing Chinese demand and economic challenges that raised concerns about oversupply in August and early September 2024. The ICE Brent futures fell by approximately $10/BBL during this period, with prices trading around $70/BBL at its lowest level since late 2021. The lack of a significant increase in oil stock price can be attributed to the persistent oversupply concerns and decreased demand from major markets such as China. Despite minor fluctuations and short-term gains for specific oil and gas sector indices, the broader crude oil market has not experienced a substantial increase in prices over the past year. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth is primarily driven by strong market demand and favorable trade policies, particularly in container shipping markets. The company has experienced significant increases in revenue from various segments, including Asia, plus 4.5%, North and South America, plus 15.2%, Australia and Africa, plus 11.5%, and a notable increase in service income from vessels, containers, and information technology services. On the other hand, revenue decline is primarily attributed to factors such as increased capacity influx, arrival of new competitors, policy uncertainties, and port congestion. Specifically, freight rates declined on Trans-Pacific services, revenue per TEU decreased by 8% on Trans-Pacific head haul, and total revenue and revenue per TEU declined in Asia/Europe trade due to extra capacity from newbuilds and intensified competition. Overall, the company's revenue growth is driven by market demand and favorable trade policies, while revenue decline is driven by increased capacity and policy uncertainties. Net income and profit margins experienced fluctuations between 2024 and 2025. Net income initially increased by $121,080, rising from $834,055 to $955,135. However, it then decreased by $23,579 compared to the previous period. Profit margins also underwent changes, with the overall operating profit margin increasing from 18% in 2024 to 20.1% in 2025. Notably, the container transport and logistics segment's operating profit margin declined from 21.1% to 19.3%, while the others segment saw a significant increase from -0.2% to 53.9%. These changes suggest that the company experienced both growth and decline in different areas, leading to overall fluctuations in net income and profit margins. The company's financial performance indicates a strong ability to generate cash from its core business operations. The net cash from operating activities and cash generated from operations for the year 2025 are both substantial, totaling $1,124,771 and $1,172,946 respectively. This suggests that the company is successfully converting its earnings into positive operating cash flow, a key indicator of financial health and stability. The company's debt level has increased significantly from an unspecified amount to $1.4 billion. However, the interest expenses have shown mixed results, with a decrease of -$244 on one occasion and an increase of $1,998 on another. Overall, it appears that the company's debt level is a major concern, while its interest expenses are experiencing fluctuations. The company's financial summary reveals a mixed performance across different trade segments. On the positive side, the transatlantic trade segment saw a significant increase of 14% in total lifting and 18% in total revenue. Similarly, Intra-Asia/Australasia trade experienced growth of 8% in liftings and 16% in total revenue. OOCL Logistics also demonstrated resilience across its operations. However, the Asia/Europe trade segment struggled, with a 1% reduction in total lifting and a 6% decrease in both total revenue and revenue per TEU. These contrasting results highlight the varying levels of performance within different regions and trade segments. Management's outlook and strategy. The company aims for balanced growth across regions while prioritizing a customer-centric approach. To achieve this, they plan to strengthen partnerships with COSCO shipping lines, invest in emerging markets, build an eco-friendly fleet, and develop a digital supply chain. Management is confident in adapting to the global environment through digital leadership and market development in key emerging markets, ensuring operational excellence along the way. Supply chain disruptions loom large. The current market is plagued by concerns of inventory buildup and supply chain disruption. Several factors contribute to this issue, including vessels sailing on major routes being nearly fully loaded, which may hinder market development. Additionally, disruptions in the Red Sea, port congestion in European ports, and the ongoing uncertainty surrounding U.S.-China tariffs further exacerbate the problem. These issues create a perfect storm of challenges for businesses, threatening to disrupt supply chains and lead to inventory buildup. The situation is fluid, with tariff policies changing frequently, adding to the uncertainty. As a result, companies must be prepared to adapt quickly to mitigate the risks associated with these disruptions. That concludes the financial summary for Ooil. Feel free to comment below, and I will be happy to answer them when possible.